Major funding for these broadcasts has been provided by grants from New York Community Bank, AmTrust Title Insurance Company, Perfect Building Maintenance, M&T Bank, Customers Bank, Marks Paneth LLP, Capital One Bank, Collins Building Services, Meridian Capital Group. Additional support has been provided by grants from AKA Hotel Residences Corman Communities, Ariel Property Advisors, Amarant Bank, Bank of America Merrill Lynch, Briarwood Organization, Chase Commercial Mortgage Lending, Chase Commercial Term Lending, Citizens Bank, Dime Community Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC, Handler Real Estate Organization, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Casamatides Red Apple Group, Keysight Capital Partners, Matone Group, New Banks, Newmark Knight Frank, Ocean First Bank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Services, Stonehenge NYC, SVN CPEX Real Estate Services, Tierra CRG, the Meringer Family Foundation, and these friends. So what's happening in the world? Are there opportunities to be in real estate business? Are there opportunities to be in the apparel business? Are there opportunities in affordable housing? Where are we going? So today, I'm put together a group of individuals to provide their insight on different topics. My guests include the partner in charge of the commercial business, Howard Hoff at Marks Paneth, Steve Casson, who is
Managing partner
of Infinity Real Estate.
Depends on the day, really.
Okay. Then I have the managing partner, CEO, Jim Simmons of Asland Capital. And last but not least, I have Shalini Meher, who is the managing director at Meridian Investment Sales. So since you are the last one we're going to talk, and you've been involved with the multifamily business, a lot of things took change on June 14th of last year. What effect have you seen in New York City with regard to the rent-regulated multifamily?
So overall, I would say every landlord who owns multifamily, especially the rent-stabilized stock, has seen a value dip of 30 to 50%. We're starting to see a lot of sell-offs from old-timers or people who are ready to get out of the business. And we're also seeing a lot of sell-offs now coming in from people whose loans are coming due. And what's going to happen is they can refinance, but they're going to have to come in with more equity, and they don't want to do that. So those are most of our sellers. And on the flip side, if anything, the barriers to entry in the New York market are lower, right? Because we've got increased cap rates, so there's much better returns. There are people who are going to look at the New York market now who never did before, and the financing is really attractive. You can get a 5-year loan at 3% with 2 years IO. So there's two sides to the coin, and I, of course, feel.
So that's a perfect lead-in both for Steve and for Jim. You recently bought a property in the Bronx, correct?
That's correct.
It's a multifamily rent-regulated building, correct?
It is, but it has a few bells and whistles, which mitigate some of the issues that happened in mid-June. The first of which is we did a public-private partnership with the city of New York, which guarantees affordability over the next 40 years. And for that, we get a tax abatement. And that makes our returns that much more robust than in a normal rent-stabilized manner. I agree with everything that she said about the market. I think that what you'll see, though, is a change in the investor type and the investment thesis. And it'll go back to what you had prior to the early 2000s, which is long-term hold. by long-term 15, 20 years plus, enjoying strong cash flow, not really banking on a big pop when you sell based upon the activities that you do in a value-add sense, but steady increasing of revenues over time based upon increases that are regulated.
So here's a question. Difficulties of operating in New York City as a landlord. Let's talk about it, Steve.
Where do I start? So the good thing about New York is if you deliver a product that is compelling and the price point is compelling as well, you can have high occupancy. The difficulty that I think we're all facing is a result of the last cycle's run-up in values. So many of us acquired properties at very thin margins and didn't anticipate the inflation we would see almost across the board in expenses. And we're struggling with the disproportionate increase in rents. So what I'm getting at is I think net effective rents have actually either stagnated or have deflated throughout the last 4 or 5 years at a minimum. With regard to multifamily investments, our portfolio is mostly out of New York City, but we do have a handful of buildings in New York with multifamily rentals. And if it plays out that valuations allow for greater returns based more on cash flow in a hold type scenario, we might come back. We need that margin of safety and we need an adequate return that's not based on a disposition.
You know, people believe that retail is dead, but I think you and your properties have shown that retail is not dead, you know, especially urban retail.
Mm-hmm.
I mean, the retail in the boroughs is doing great. Let's talk about what you did in Brooklyn recently in the sale and so on.
Sure. I think retail is going through an evolution, and it's a bit, maybe it's happening quickly, it's happening drastically to some, and I think that's inherent in the world today. The tectonic shifts just happen quicker and more severely. We see this in the stock market, we see it in political changes that lead to the event in multifamily regulation, et cetera. But when it comes to retail, you need to kind of step back and really look at what has always worked and then what worked during temporary periods of exuberance and what is working today. And the day-to-day needs of people, neighborhood needs, services, in low to mid price point corridors is there, the demand is there. And the performance of the users are still robust. I think the part of the retail business that is forever changed is destination retail and high street retail. Destination retail is just disadvantaged in that it replaces entertainment, and the tastes of consumers are changing. So that Sunday drive to the mall to spend 3 or 4 hours, take some money out of your wallet, and have some entertainment and time spending value, that's challenged because of the evolving consumer and just the environment surrounding that, technology being one factor. And high street retail just got ahead of itself. Companies were awash in cheap capital. Multiples on these companies were beyond comprehension, fundamental comprehension, and everybody was kind of drunk on it. So brands and retailers in that sector started doing deals that fundamentally don't underwrite. And I think that in that sector, we're seeing a more reasonable and calculable reset of that retail model.
Howard, you specialize in handling commercial businesses, and a large number of them are apparel and jewelry, but let's more talk about the apparel companies. The apparel industry is surviving in certain ways with the TJ Maxx's and the Marshalls, and the off-price locations. Are they specifically making the merchandise for the off-price clients, or are they selling it to the traditional retailers, and then whatever is left is they're selling, like the Sims of years ago and the Mandy's and the other type of shops?
Sure. Well, as you can see, you've mentioned several stores that don't exist anymore. So
that's right.
The closeout market is getting smaller and smaller. What I'm seeing is the retailers are not there to sell to. So the malls, as you brought up, right? Mm-hmm. There's less and less stores in the mall. So what you see is they're manufacturing into both the closeout and into the full price. And the full price is going into the off price. I'd say it's probably almost 50% going to the off price at these days because those are the stores that are thriving.
And how much of your clients would you say is being made in America or being made domestically at all?
Only special orders, things that have to be done quickly. Everything else is coming through overseas. All the countries you were mentioning before, between China is major, India, Bangladesh, depending if it's also if it's towels, sheets, and that end of the marketplace. India has a very big stronghold in there, as well as Bangladesh. But for the most part, it's the Chinese. A lot of stuff is starting in
What
China.
happened to the Philippines and the Dominican Republic?
Jewelry is very big in the Dominican Republic. They're still there. There's still several factories that are there. They're not as many as they used to be, but I have several clients that own factories still in the free zone.
How does a small manufacturer make a living operating in New York City today? Is it more of the sales office, the administrative office, or are they doing, what kind of business are they doing?
In New York City itself, they're trying to keep the real estate that they're occupying is very small. I have a lot of clients moving out into Queens, into Long Island City, taking advantage of the
REAP benefits?
That's it, which is also very painful to qualify. It's a long process to put it in. You have to sign a lease, you're getting in there, and then you're finding out what you're getting. And if you're not getting enough, it was a bad decision to make the move.
So here's the question, Steve. Where are the opportunities that you see in general today, 2020? You know, the market's a little bit down recently due to the virus and other situations. Where are the opportunities for a real estate company like you are in development?
So regionally, I think you need to look at neighborhoods that are still in transformation, and there are quite a few. If you draw like a 10-mile ring around Times Square, there's still pockets of opportunity because there are places that are still transformative, and they provide very low-hanging fruit opportunities in certain sectors like medical, neighborhood retail, lower price point condominium, et cetera. So I think that's an interesting kind of niche business for people that can really do a block-by-block strategy in their search for properties and potential development sites. Regionally and nationally, I think that lower cost cities. So we still find that there's a lot of positive momentum in places like DC and its surrounding markets, Philadelphia, less hot submarkets of Miami Beach and southern Florida. There are places where young people can find work in a broad cross-section of industries. The cost of living is much lower than it is in New York. Tax structure is probably more favorable. And then the quality of life is better. And a place like Philadelphia, which never had really high highs or really low lows, is an interesting market because even though it's too small on the multifamily end for most institutional buyers, it's an interesting place for smaller operators because the city is undergoing a slow but sustainable renaissance, the downtown. It's becoming a 24-hour city, and it never was.
Jim, where do you see the opportunities today?
I want to dovetail on what he just said, which is if you look at some of the neighborhoods and if you identify the transformation agents, so in Upper Manhattan, Columbia University's new campus, that's changed the face and will continue to do so for Manhattanville. We're in Old Town Alexandria, Virginia. Amazon's HQ2 will be coming relatively soon. We identified that opportunity years before they announced it based upon a location, but once they did, we're going to be creating units both in a public-private partnership, affordable and market rate, to take advantage of the extreme supply and demand imbalance there. I like Philly as well for the very reason that you mentioned, in that it's just below the institutional radar of most firms, but if you have institutional capital but can play at that south of $50 million per transaction range, then you can amass a nice portfolio of assets.
Here's a question for Shalini, and then also relating to, everybody's been talking about the Bronx, okay? How do you see investors looking at the Bronx with regard to multifamily?
The Bronx is probably still has the most affordable housing and will continue to have the most affordable housing and new mixed income and new projects, 70-30 projects and all of that stuff. You know, in terms of arrears and tenants not paying and issues with sort of the tenant base, there's also the highest risk there. You know, in terms of all the deals we're closing right now, the Bronx probably has the highest cap rates. You know, we're probably selling those at, 5.5, 6.5 caps. We even sold one at a 7 cap, but it did have a fair amount of issues in the building. So I think it'll continue to gentrify, but it will always have affordable housing and workforce housing.
Jim, you in your prior lives, you've owned properties in the Bronx quite a bit.
We did, and we do today. Look, interesting enough, you have to look neighborhood by neighborhood and sometimes block by block. I think that the Bronx will continue to be fertile ground for investment. I think you just have to be thoughtful about how you do it. And if you are in the game for high octane returns, where you have a 5-year to 7-year time horizon, I think it's probably not the best place to be, save maybe Mott Haven, where there's a huge transformation occurring. But if you're looking for a place where you can buy something at a very attractive cap rate, 6+, and finance at a 3, I think that's a very attractive spread to a lot of investors.
Steve, what about you with the retail opportunities in the Bronx? I think it's an urban retail, and it's a good area, in my opinion, in certain markets in the Bronx.
Yes, it is. It's still relatively low rent. This might not be, super. What's the appropriate word? It might not be a popular point of view, but the nationalization of a lot of the Bronx's retail corridors hasn't happened yet. So as things consolidate.
So it's more the mom and pops, though.
It still is. It still is. And I think it's reflective a little bit of the consumer and some of the operational challenges of being in those types of neighborhoods. And also some of those blocks don't have the floor.
Yeah, you don't have the
floor plates. Kings Highway, which you mentioned earlier, was an example of that. The reason we had our pick of the litter for larger format national tenants is because we were the only 5,000 or 6,000 foot plus floor plate, and having a floor plate 3 times that amount was extremely rare. But I don't particularly focus in the Bronx. We've looked at some medical development in the Bronx, but otherwise I can't claim to be an expert.
Howard, one of the topics, and I'll relate it to everyone to answer the question, is the subject of the opportunity zones. Many of the properties in certain parts of the city and around the country have sold at higher prices because of the deferment of the taxes on the opportunity zones. Have any of your clients who are in the manufacturing business, where you can get a deduction and you can also defer taxes on the profit, been involved with opportunity zones?
Believe it or not, I've actually had conversations with some of the clients that have absolutely no interest. They're worried about what's happening in the next 3 to 5 years, and they're worried about locking up any capital and so forth. So they also are very leveraged, because the garment center, jewelry are very leveraged companies, and they're not looking to take on more leverage at the time. So it was very interesting that they really had no interest in them.
What about your thoughts about the opportunity zones?
I struggle with the whole concept because there's a significant misalignment between business plan, scale, and capital profile that's required to enjoy the benefits of it. So when this legislation was first passed, and then everybody scrambled to clarify it and quantify it as quickly as possible, we became students of this very quickly and thoroughly. And from an academic perspective, we get it. We happen to own 2 properties inside of opportunity zones, and we're still grappling with what direction to take, because again of these practical misalignments. So
right, because
I don't know,
money has to be in the business for a
minimum of 10 years.
Right.
You can't make certain types of distributions. It's very.
And if you own the property previously, you have to maybe change the structure. One of Howard's partners, Abe, just brought it up. Abe, with regard to a lease, because that's the way you may be able to do it. But it's a difficult thing. How about you with the opportunity zones?
Yeah, so I happen to have some experience having been a part of the empowerment zone legislation. Very, very laudable proposed outcomes. And I think that the thought behind it was that you'd be able to improve neighborhoods. I think part of the issue has been the timing was such that the transactions that got done, particularly the ones fresh out of the box, were transactions that would have gotten done anyhow. They were already on the board, they underwrote well, and what it did, which is what it should have done in most instances, was it made a good transaction better. My fear is that bad transactions get done just for the sake of the legislation and the proposed tax breaks that don't pencil out, that we'll look back 4 or 5 years from now and say that the legislation was a failure. And it wasn't the legislation that was a failure, it was the underwriting going in and the expectations of what
As
was
someone has said to me on my show on this topic, if it's not a good transaction, it's not going to be a good transaction with an opportunity zone
Of course not.
at all.
Agree with
Have
that.
you seen certain properties selling at higher multiples and prices
No.
because of the opportunity zone?
No, and I agree with Jim. The deal has to make sense today. We're living in today, and we still have, if universal rent control hits, that's going to affect all the free market apartments. There's still a lot of uncertainty, and I am hopeful that things will change in the future. But I think everyone I speak to is operating in today and a 3 to 5 year time frame.
What about, one topic which has increased interest around the market is transit-oriented developments. Living in Westchester and working in New York, or vice versa.
Well, just riding the train every day, I can see the tremendous amount of development that's happening around the train stations. One of them is, we brought up New Rochelle. There's several buildings that went up right there. They're advertising all over Metro North. Stamford is doing the same thing in Connecticut as well.
Steve?
It's critical. I think every city we're invested in and active in civic endeavors and quasi-political groups is heavily focused on 2 issues, climate change and transportation. And it's for good reason. People are working and living much closer to one another, which is part of, a modern existence in an urban environment. And the density increases are creating untenable traffic patterns. So living 25 or 30 miles away and commuting by car is a very different endeavor today than it was 30 years ago. So every single city we're involved with is focused on this issue, and I think for good reason.
Jim?
They're right. For almost every transaction we look at, that's a part of the analysis, which is how quickly can residents get to where they work. Not everyone will choose to or can live very close to the city center, so you're always going to have suburbs. And I think the metric by which those that win and those that lose, meaning the suburbs, will be how much housing do they have close to the transportation nodes that people can get to the employment centers quickly, efficiently, as opposed to having to drive, park, get on a train or a bus.
Also, what I'm seeing is a lot of the companies are pushing out into space out in the suburbs in order to be able to get a bigger pool, decrease their costs, but also cut down the commuting time because the millennials coming in want a better quality of life. So the more you can cut down on their commute time so they can have their personal time to make it, and not for lack of a better way of saying it, is better off and you have a better employment situation.
Everybody, were talking last year, especially with the semi-debacle of WeWork. Any thoughts about the co-working business?
It's worked out for several of my clients in the garment center that were having financial problems. They got out of their leases and they brought down $200,000–$400,000 of cost by moving into a WeWork situation. It's not, I don't believe it's the answer, but it's an option if that somebody has to downsize to regroup and reinvent their business.
Stephen, since you're always innovative and you like different businesses, have you and your partners ever thought of the co-working and the co-living?
We looked at this from 2 different points of view. As a landlord in certain markets that might have felt ripe at a certain point for pre-built space. So some version of a co-working model. And then we also looked at it from a VC side because over the past few years, if you're active at all in private placement investments, you've been pitched a half a dozen times by co-working concepts. I believe in the model. I think that there's a need for it as upfront capital becomes more scarce in the small business environment. People want to start their own business, do their own thing. It's a form of financing for small businesses. And I think it's also a form of non-committal office space solutions for larger companies that want outposts, that want to give people this flexibility not to commute, et cetera. How deep the market is, was it growing at the pace and at trajectory claimed by WeWork and some of the others fueling that? That I can't speak to. I'm skeptical, but I think that the concept in and of itself is something that's going to be around in the future.
Shalini, have you seen co-living, some of the apartments that you've sold, the multifamily, where people are, changing the structure and building co-living apartments?
Occasionally we get a building in and it is leased up to sort of one operator who's running it like that. I find those a little tougher to sell because, how they're going to do over the long term is still very uncertain.
Right, and the banks basically look at it at the original rents. They don't look at the projected rents of the combination.
Exactly.
Have you?
We've looked at a couple, actually. We've looked at some of the companies and we've looked at a couple of transactions. I think it will be a sustainable sector of the real estate pie, similar to self-storage, medical office. Some of the numbers we've looked at, apparently they're getting about 20% growth in NOI, but there are longevity issues that need to be asked and answered before we jump in with both feet.
The industrial market. Stephen?
I don't participate in it.
Not really.
Nor do we.
I try. I haven't sold anything yet.
I'd like to thank Howard, Stephen, Jim, and Shalini, and I'll see you next week.